Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, episode 108, the new reality. Things are hot in the stock market, growth stocks everywhere, and I'm sharing my learnings and my decision making on whether this hot, amazing stuff is the real deal gold or is it fool's gold. Thank you, Dolly, for that image. We are at 265 something subscribers, about a year and a half in. Thank you again for your support. If you're new, please use the playlist and make sure you are aware that I have no magical powers. I am often wrong. Please do your own verification. Don't trust me. Well, I thought I'd share my learnings for this last week in three parts. One is to share my awe and amazement at the new reality. Anything with an AI is flying high, and kind of assess the risks and rewards of chasing that dream. And I'm going to make my own calculation and I'm going to share the moves I made in terms of did I risk it for the biscuit? Here we go. Before I go any further, I want to make sure you know that I am not a wealth management advisor. This is not tax advice. I do not have an agenda. I do not short stocks, and I am not trying to pump and dump. So make sure you do your own, due diligence as well. And oh, by the way, I don't endorse products or politics either. Well, my quick check, I went into the S&P Dow Jones indices and dug deeper into the oil and gas industry. And only because I'm fascinated by a reality here. And the paper goes to spglobal.com, and you can see the Dow Jones US Oil and Gas Index. And it shares that the average oil and gas company is a cool $40 billion in market cap. And there are about 45 in total, which means it's a $1.8 trillion market cap sector. That's pretty amazing. So the US oil and gas Dow Jones Index has about 1.8 trillion of oil and gas companies. And you then look at how much cash does it produce. And this is from Moody's. And just the top five, only the top five, BP, Chevron, Exxon Mobil, Shell, and Total Energies, just the top five in the Dow Jones Oil and Gas Index produce a cool 613 billion of cash every year. So to put it in perspective, 1.8 trillion in market cap, 613 billion in operating cash, kind of sort of a 1 to 3 ratio. And then I look at Microsoft. To be clear, I'm not shorting Microsoft. I have nothing against them. I think they are an amazing company. And they produce about 87 billion in operating cash. And what an incredible growth story, Microsoft. And so I just thought I'd put these two things side by side. 615 billion in operating cash produces 1.6 trillion in market cap. 87 billion in operating cash. What do you think the market cap of Microsoft is? Give or take a tenth of the 1.6 trillion. Surprise, surprise, Microsoft can buy the Dow Jones entire index 2 times over. 3 trillion in market cap. And that is the stuff that, I'm thinking it's AI. Because a dollar of cash produced by an energy company is worth $3. A dollar of cash produced by Microsoft is worth $30. Absolutely amazing stuff. And so that is when I start looking at, should I be buying growth stock? Should I be jumping out of the AI bandwagon? What does my heart tell me? And I feel like I'm doing a wonderful walk in between the devil and the deep sea. Dolly, thank you again. And when I look between the devil and the deep sea, by that I mean chasing the dream of the AI stocks and saying I want to ride on that rocket ship, or possibly getting hurt in doing that the wrong way. And I keep thinking about should I not? And I come across more stocks as well that defy gravity, in my opinion. Here is ARM Holdings, another semiconductor manufacturer. And this, I'm told, is the future of AI chips. How awesome. And so I dug deeper. ARM has operating cash flow of 900 million. So 900 million in operating cash gives 100 billion in market cap. Let me restate that. $1 of cash generated by ARM is worth $113. $1 of cash generated by the oil and gas companies are worth $3. What am I doing wrong? So I sit there and say, maybe buy and hold, buy a value stock and hold. That must be the wrong stuff. Maybe I should walk between the devil and the deep sea and take a chance. Because if I buy a small group of stocks, the sky is the limit. Maybe that is the right thing to do. And even in fixed income, I keep worshiping this T-bill and chill. And if I did that and the interest rates drop suddenly, then I have no place to go. I missed the boat on the growth stocks and I missed the boat on interest rates. Am I doing something wrong? And that is where I started thinking about, should I risk it for the biscuit? Dolly, you did a great job. There are the growth stocks, which are the biscuits. And I am trying to figure out, is that step too far? Should I take that step and should I go? And I took a deep breath. I did a whole bunch of research and I started thinking through really the three options. My fixed income strategy is doing okay. It certainly is not producing the kind of dividends that the growth stocks are producing in terms of meteoric growth, which is amazing. So I could go chase the AI rumor, or I can stay behind, step back, live another day. And when I went back to my principles, I came to a very simple decision. I am going to step back and live another day, except I did decide to make a small change. Instead of 10% equity, I am now extremely tilted towards fixed income, 94% fixed income, and give or take 5% in stocks. But here is what I'm thinking. In that 6%, I am going to take more risks. Let me explain more. That 6%, you can see that I'm pretty much locked into small cap equities, even in the current allocation. 90 odd percent is in fixed income, and that 6%, give or take, is in small cap equities. And so I started thinking about how would I do this differently? Should I stay in fixed income and T-bills? Should I rethink how I'm doing my equity allocation? And so here is what I came up with. Within my equity allocation, you can see that I'm doing fine. My large cap equities produced a 15% return last year, except remember it's a very small allocation. But if I had just put my money on the S&P, it would have grown by 26%. My small cap, my Russell, produced 19.41, so I'm pretty happy about it. I beat the Russell 2000. And fixed income, it shows that I produced 7.1% returns last year. That is a little deceptive. It's not only fixed income, it also includes agency bonds, it includes bank loans. So, I do show a slightly higher return than reality when you compare these. So what I thought I would do is maybe I should take more risks with the 5%, but measured risk. And so here is what I came up with. I went back to my wonderful screeners and I thought I would increase my volatility in a measured basis. And here is how I'm doing it. I set up a Schwab screener that says, tell me these stocks where earnings are coming up within the next 30 days. And as far as that one filter is concerned, that alone introduces volatility because if you get the call right, then your portfolio goes up in value. If you get it wrong, too bad, so sad. And so I said, within the stocks whose earnings are coming up in the next 30 days, now give me the cheap stock. Now give me the ones that have a good cash flow, a good profit, low debt, high return on invested capital. And that is where, when I ran that filter, I got pretty much the same suspects as before. Note the conflict of interest. I'm not suggesting you buy or not buy. I'm sharing what I did. So Encore, Wire, and Chesapeake, and TK Tankers, those are all there. I did notice Dillard started popping up. Their earnings are coming up and they have really solid financials. So I am building a portfolio, a little bit of positions in Dillard's. But I noticed there are two others that I ended up. UFPI, they make these trusses and things like that for building construction. Their earnings are coming up. They have really solid financials. And so those are the two that I started taking positions in. And I'm going to try this for my 5%. But if you look at the 94%, which is the fixed income, there again, I have some really solid distributions. And as you can see, my agency bonds plus treasury bonds are 40%. T-bills, which are very short term, are 50%. And if you look at the sectors, pretty much 85% of my fixed income are in US treasuries, one way or the other. They are treasuries, agency bonds. I do have positions in ETFs on bank loans. I use that to generate dividend income. And the three that I have, and please do your own due diligence, the three that I have are SRLM, VVR, and BISD. Those produce 10, 11%, something like that in dividend income. Some of them or all of them pay monthly, so it kind of keeps the cash coming for me. And those are the ones I use. They are higher risk. VVR is a leveraged ETF. Be very, very careful. This is by no means suggestion that you should buy any of them. So having said that, you do look at my credit ratings, and a very large percent of mine are AA or AAA. T-bills are not rated for credit rating because they're considered cash. So the only time I go below the AA credit rating are the bank loans and the credit in VVR and things like that. So I have about 20% of my portfolio fishing in the deeper ocean below investment grade, but the rest of it are all investment grade or cash. And in terms of duration, I practice what I preach rather. More than half of my portfolio are within 90 days, positioning for April 30th, when I believe, unfortunately, there'll be more dysfunction. And then in the longer duration, I have agency bonds. Aside from that, it's a very simple fixed income portfolio. So end of the day, I did not take the growth cookie. I took the fixed income cookie. And here is what I'm doing. I'm staying very short term in T-bills. And I am taking higher risk by looking at equities whose earnings are coming out in the next 30 days and making educated decisions there. And I do not have the itch to risk it for the biscuit. Hey, even a blind squirrel can find a nut once in a while. Don't trust me. Do your own homework. Thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.